All right, welcome to Macroeconomics. In this video, we're going to cover Chapter 10, the stock market and personal finance. We chatted a little bit about stock markets the other day. The New York Stock Exchange, about 2,400 different companies are listed on that exchange, about 21 trillion in value. The NASDAQ is another stock exchange. There are about 3,800 companies listed in that index with a value of about 11 trillion. We sometimes also look at indexes of stocks. An index is simply a group of stocks that we look at to try to measure some change in the economy. The most common index that we look to is the Dow Jones Industrial Average, or the DJIA, or many times we talk about it as we call it the Dow. It's essentially 30 leading companies in the U.S. If you look at this list, you'll notice some of them that you are probably familiar with, such as Apple, Disney, Home Depot, McDonald's. The idea is we take the value of all of these companies, put them together, and then we watch that overall value change over time to get an idea of how the economy is moving up or down. There are a couple of other indexes. Standard & Poor's is another index. It's actually two stockbrokers. One had a company called Standard, and another company was called, his name was Poor, and they combined their company and created this index, and it's the S&P 500. Instead of just 30 companies that you find in the Dow, this actually is 500 companies. And some people think it's maybe a little better indicator of how the economy is doing. So you have the S&P 500, and there's also the NASDAQ index that looks at all of the companies from the NASDAQ stock. Once again, there's over 3,000 stocks in the NASDAQ. These companies tend to be smaller and more high-tech companies. So with an index, you've got these three that you can look at. All right, so when we talk about investment in economics, we really have two different types of investment. We first of all talk about investment in our GDP equation. In that case, it's purchases of new capital equipment for businesses. It's also a term we use when we talk about stocks and bonds, making financial investments. So let's take a minute and talk about different types of firms. A firm is an organization that organizes capitals. So the firm can be a for-profit firm. It can be a non-for-profit firm. Any organization that's designed to try to organize capitals, we can refer to it as a firm. So in terms of the legal status of these organizations, they fall into one of three categories: proprietorships, partnerships, and corporations. There's issues with each one of these types of firms, advantages and disadvantages. We think about the complexity, the liability, the taxes, raising money, and control. So let's take a moment and talk about each one of these types of firms and how they relate to each of these issues. So let's begin with proprietorship. A proprietorship is a one-owner operation, and the very easy to create. There's only one tax. The income is passed through to the owner, and it's taxed at that individual's personal tax rate. The disadvantage of a proprietorship is liability is not limited. You have unlimited liability for the things that the proprietorship does. So the owner of that firm is personally liable for the firm's debts and obligations. Proprietorships also sometimes hard to raise money, and they also end with the death of the owner. They don't go beyond the life of the owner. Partnership, very similar to a proprietorship, but it's two or more owners. It's also somewhat easy to create. The big advantage is that you can combine talents of multiple people as a partnership. The disadvantage is that all the members of the partnership are liable. And the issue there is we have problems with disagreements that arise, and how those disagreements are resolved sometimes can be a large problem for partnerships. Partnerships also end with the death of one of the partners. The third type of business firm is called a corporation. You can have one to many owners. A large advantage is the liability of the owners is limited. All that an owner of a corporation can lose is the amount that they've invested in the corporation. They cannot lose any more than their investment. It's also generally easier to raise capital if you have a corporation. And it doesn't die with the shareholders. It has a life of its own. It will continue after the death of a shareholder, and shares can be willed or given to another party at the death of a shareholder. A problem with corporations, they're harder to create, there's more regulation, and you also have double taxation. Double taxation is a situation where the corporation will have to pay taxes, and then when the owners of the corporation receive dividends from the profits, they have to pay taxes as well. So a little problem there with corporations is this idea of double taxation. So in terms of the way these organizations are developed in their revenue, about 70% of the companies in the U.S. are proprietorships, small one-owner businesses. They also collect about 4% of the revenues. About 10% of businesses are partnerships, and they collect about 16% of revenues. Corporations represent the around 20% of the firms that have been organized, and they, as you note here, collect the large portion of sales revenue. Almost all the companies that you and I deal with are going to be corporations. All right, let's also review the idea of a dividend. A dividend is a portion of the profits paid to shareholders. So think about it this way. You have a pie that represents the profits. You slice up that pie depending on the number of owners, and each owner of the company gets a proportionate slice of that pie relative to the number of shares that they own in the company. So raising money. If a company would like to raise money, there are several different ways that you can do that. The first way is that you can retain earnings, or you can keep the profits that you earn. Instead of giving the profits to the owners of the company, the owners may elect to have the organization, the firm, retain those earnings and then use those funds to invest in growing the company. A second way to raise money is to sell ownership shares. Investors are given the option to be able to buy shares in a company, and those shares give them the right to future profits. Shares in a company generally carry no guarantee for future profits. So why would someone ever want to trade cash for shares? The reason that people invest in shares is they are hoping that that company will do well financially, and they will be able to share in those profits in the future. The third way that a firm can raise money is by borrowing. They go to a bank, they can go to a relative, they can go to a debt market where people will loan them money. Once again, the contrast between shares and debt is a shareholder does not have the right to profits, does not have a right to minimum income. They are taking a larger risk in hopes that their shares will increase in value or the company will declare dividends. When a company borrows money, they are promising to pay back those loans in addition to interest. Okay, all companies have financial statements. The two fundamental or foundation financial statements are income statements and balance sheets. An income statement simply says what happened between two dates, how much revenue was generated, what were the expenses that the firm incurred, and the difference between the two is the net income. The second statement that's looked at is called a balance sheet, and this asks the question, what is the status of a company on a specific date and time? It really asks, what do I own? And those are also called assets. And what do I owe? And those are called liabilities. The difference between assets and liabilities is net worth. The reason they call it a balance sheet is the assets have to equal the liabilities plus the net worth. It must balance. Also note that somebody's net worth can be negative. So I can have assets of 100 but liabilities of 150, so my net worth would be a minus 150. Okay, so in deciding whether you want to invest in a company, these are the two foundation financial statements that you would want to look at, the income statement and the balance sheet. So the question is, what do you do with a company that hasn't actually been formed yet, a proposed company? Well, in that event, a entrepreneur will make forecasts about what they expect their income to be in the future and what their balance sheet's going to look like in the future. And those are called pro forma or future prospective income statements or balance sheets. All right, so how do you value what a company's worth? There are a variety of different ways. The fundamental way that we do that for corporations is we look at the stock price and multiply it times the number of shares that are outstanding. So if a company's stock is selling for $50 a share and there's 1 million shares outstanding, that would suggest that that company's worth $50 million. The way to think about this is if you wanted to buy the company, what would it cost you? You would have to pay $50 a share for those 1 million shares. That company would cost you $50 million to buy. So let's look at an example. Let's do a quick valuation on Apple. Their current price is around $189 a share, and they currently have about 4.6 billion shares outstanding. So what would be their value? Well, if we multiply 189 by 4.6 billion, we get around $870 billion. Here's what I'd like to have you do is I'd like to have you go to this website, wolframalpha.com, and take a look at these 3 different companies. Apple, every company that's publicly sold has a little abbreviation or nickname, or it's called their stock symbol. The stock symbol for Apple is AAPL. The stock symbol for Amazon is AMZN, and the symbol for Walmart is WMT. If you go to this site and just type in the window that comes up, those stock symbols, it will give you very interesting information on each one of those companies and let you compare those companies side by side. We'll take a little time when I get back on Friday to see how this works. Okay, another thing that we want to recall is that we have accounting profit and economic profit. Accountants will want to see a receipt for all costs, and we also think of these as explicit costs. Economists also consider explicit costs, but in addition to explicit costs, they will also want you to consider implicit costs. So think about this for a minute. If I were to ask you how much it cost you to go see the Avengers movie, what would your answer be? Well, you might say it depends. Whether you want me to talk, whether you want just to know the explicit cost or if you want to know the explicit and the implicit cost. So let's say a ticket to see the movie is $10. So our explicit cost would be $10. But remember that you also have implicit costs, and the big implicit cost that we have in life is our opportunity cost. So if the movie's 3 hours long, and I could work at McDonald's, for example, and earn $15 an hour, I'm really giving up 3 hours times 15. I'm giving up $45 in opportunity cost or implicit cost, plus the $10 explicit cost of the ticket price. So it would be $10 plus $45. The economic cost would include both of those, and that would be $55. So when someone says they really can't afford to go to the movie, it may not be that they can't afford the price, the admission price. What they can't afford is the opportunity cost to go to the movie. Hopefully that makes sense. Okay, so now we want to move forward and talk about finance. Finance is represents a body of knowledge that exists within the economic world. It's an area of economics. It deals with these two ideas of time and risk. Okay, so when we talk about time, we can abbreviate that with either a T or an N. T is time, or N is the number of time periods. And we also will refer to risk, and we abbreviate that with an R or an I for the interest rate, or the interest rate risk. All right, so the foundation formula of finance, basically all of finance is based on this formula. It's the compounded growth formula, and it's equal to 1 plus R, or the rate, raised to the power of N. Note that N is an exponential. R is the risk rate, and N is the number of time periods. Sometimes you'll see this equation as 1 plus I raised to T. All right. Okay, so how do we calculate the future value of something? We're trying to figure out what something is going to be worth in the future. A future value is equal to what it's worth today times the factor that we calculate from this equation. The factor in this case is the growth formula. So R is the rate, N is the time period. So what would be the case if R was 10 and the number of years was 5? Could we calculate that? Well, we'd take 1 plus R raised to N. In this case, it'd be 1 plus 0.1. Remember, 10% is also 0.10 raised to the power of 5. When we do that, 1.1 times 1.1, we do that 5 times and we get a value of 1.61. So when we ask what the future value of something is, we simply take the value today and we multiply it times this factor that we've calculated. So if we had $100 today, what's it going to be worth in 5 years from now if the growth rate is 10% a year? And that would be 100 times 1.61, or 161. So future value is compounding, or we sometimes say future value is multiplying. Sometimes our problem isn't what something's going to be worth in the future. We're trying to figure out what it's worth today, what it's going to be worth today. So Grandpa says he's going to give you $500 when you graduate. What would the value of that $500 upon graduation be worth to you today? We recognize that people have a time preference, and that time preference is always suggesting that people prefer to have something today than to wait until tomorrow. So we know that $500 in the future has got to be worth something less than that today. So the way we do this is very similar. We take the present value is equal to the future value amount. In this case, we're going to divide it by the factor and not multiply it. So the present value of $100 in the future, if we were going to wait 5 years and the compounding rate was 10%, would be 100 divided by 1.61. Once again, note that we're dividing here, or sometimes we call it discounting. So 100 divided by 1.61 is going to be $62.11. Think about it. If I had $62.11 and I was to put it into an investment today, and that investment was growing at 10% a year, and I held that investment for 5 years, it would be worth $100, or would grow to a value of $100 in 5 years. We call present valuing, also we call it discounting or dividing. All right? Okay, so to solve these questions, the first thing we ask is, what is the unknown value? Are we trying to solve a present value problem or a future value problem? We must know the rate and the number of periods. Once we do that, we can compute the factor with the formula 1 plus r raised to the power of n. If it's a future value formula, we take the value today and multiply it times the factor. If it's a present value formula, we take the value in the future and divide it by the factor, and that will give us the present value. All right, so thank you very much for watching this video. To review once again, If we have a present value, we know what the value is today, we're trying to calculate the future, we multiply that present value times the factor that we derive from the equation or the formula, and that will tell us the future value. If we know what the future value is and we're trying to determine what the present value is, we take the future value and we divide it by the factor, and that will give us the present value. Okay, that is Chapter 10. We'll be ready to move on to Chapter 11 on Wednesday. Thank you for watching this video, and I'll also be watching your quiz scores to see how well you're doing there. All right, we'll see you on Friday.